Good afternoon and welcome everyone who's joining us live, and also a big hello to those who are joining us on the replay. We're delighted to be presenting to you today Investable Solutions to the Climate Change Crisis. Investors and fund managers explore Project Drawdown. We are Highwater Women, social change powered by professional women, a nonprofit organization founded in 2005. In addition to our impact investing work, which we're here to talk about today, we also train and deploy volunteers to teach financial literacy throughout the greater New York area and provide back to school supplies for families in need. In 2013, Highwater Women held its very first Investing with Impact Symposium, the first Impact Symposium held here in New York City. In the last 9 years, we have presented over 371 speakers in 122 sessions and reached more than 2,000 participants. We've done this through panels, workshops, roundtables, and networking events. We are excited to share with you today's session on investable solutions to the climate change crisis. And without further ado, I would like to introduce you to Imogen Rose Smith, a member of our Impact Investing Planning Committee. So I'll turn it over to you, Imogen.
Thank you, Alyssa. And thank you everyone for joining us today. So we're going to do this as sort of like a fireside chat presentation hybrid, because I'm really excited that Yihana is talking to us, and she's going to start with a little bit of a presentation to show how Align Impact thinks about Project Drawdown and uses Project Drawdown when they're constructing their portfolios and working with their clients. And then we'll dig into some questions, and then after that we'll move on to the panel. So Yihana, do you want to go ahead and share your screen and tell us what you guys do?
Yes, absolutely. We'll share screen. See, is this? There's always some tech difficulties in the last hour.
Sorry, I should have given you more time to do it.
No, we're good, we're good. I can start introing while I get my slides up. So hello everybody, wonderful to meet you, and thank you for joining us here today. I am working with Align Impact, and we are a impact investing advisory firm. To give a sense of where we sit in the investment landscape, not last month, in January, when the last Highwater Women webinar on Project Drawdown was held, Brad Palmer shared that the top 5% of family offices tend to have in-house climate experts and their own climate strategy. And yet the other 95% of family offices tend to not have that. And so we at Align serve that other 95%. And we work with family offices, foundations, and individuals to help them deploy capital towards impact investments. We do that by helping investors understand where they want to move the needle in terms of impact area, help find aligned investment opportunities, and then conduct rigorous financial and impact due diligence on those opportunities to vet them. And thematically, our scope is quite broad. We cover everything from climate to social justice, racial justice, gender, education, health, affordable housing, and of course recognize that there is increasingly more intersectionality among those impact issue areas. And in terms of return spectrum, we cover market rate, catalytic, all the way over to philanthropic. We advise on public markets and private, within private funds and direct. So really hitting a broad spectrum. And I work leading our private funds investments. I've now bought myself a couple of minutes of time while I loaded and unloaded the keynote. So we'll pull it up now. And okay. And for whatever reason, my presenter notes aren't loading. So bear with me. I'm going to do it by the seat of my pants. So we'll start out by covering a couple of frameworks. First, the drawdown framework, then a pretty classical climate framework, and then I'll share a simple aligned framework that we've developed. And then we'll get to mapping actual real life investment opportunities to these frameworks. So the Project Drawdown was covered in quite a lot of depth in the last High Water Women webinar session by someone from Drawdown itself. It's a great session, so I highly recommend watching it if you have not already. And I won't go into it in depth here, but the overview of Drawdown is that it's a compilation of hundreds of studies and hundreds of data points, perhaps thousands, in order to map and synthesize climate mitigation solutions all onto the same framework. And the term drawdown comes from the moment in time where our emissions are currently increasing, and drawdown is the moment in time where we will plateau and start drawing down our global emissions. We at Align have two use cases for drawdown. First, with clients, with investors, in helping them understand the range, the rainbow of climate investment opportunities. And secondly, within our investments team where I sit, to help us hone in on the most urgent and high potential investment opportunities within a given sector. And I'll go into a little bit more depth about those two use cases. So Project Drawdown is a mapping of the sources and sinks within the mitigation framework. So sources are essentially looking at how emissions are entering the atmosphere. And you can see that there's 5 main industries: electricity, food and ag, industry, transport, and buildings. And then on the flip side, sinks, which is how we are pulling greenhouse gases out of the atmosphere and putting them back into the ground where they belong. That's the crux of climate change, is that we've literally been pulling greenhouse gases in the form of coal and oil that have sat in the ground for millennia and have been streaming them into the atmosphere over a very short amount of time. So sinks is increasing the capacity for carbon sequestration through processes like photosynthesis. And one way of visualizing this is to think about the planet like a bathtub, but instead of overflowing with hot water, it's overflowing with greenhouse gases. And there's 2 ways to prevent the tub from overflowing. We can either close the faucet, which means slowing down the sources of emissions, so slowing down emissions from electricity, food and ag, industry, and we can unplug the bathroom stopper so as to increase the opportunity for carbon sequestration. I think it's very important for me here and throughout to emphasize that it's not an either or. We can't either reduce sources or increase things. It has to be both and. We are at a point in the climate crisis where every single lever has to be pulled. And the same thing goes for industry. We can't just focus on electricity because it happens to be the biggest source. We need to focus on electricity and industry and transport and buildings. So this is a really all hands on deck situation. This from Drawdown is a similar, same information displayed differently. So the top row is sources, the bottom row is sinks, and the circles refer to the size of emissions potential reduction. So how much can we reduce emissions through electricity, through food and ag, et cetera. And this is the first use case that we have for Project Drawdown, and that is to demonstrate to our clients the breadth of climate investment opportunities available. Historically, when many people have thought about climate investing, they think, right, climate investing, solar energy and wind energy, period. That is a part of the solution, but it's just the first square, the first rectangle here. And we utilize this to show clients, if you care about food and ag, there's a space for you in climate. If you care about health and education, there's a space for you in climate investing. So really, it's much broader, and that is that's exciting, and that there's a flavor of climate investing ice cream for every type of investor across industries and across sources and sinks. This is similar information displayed differently. Something really interesting about Drawdown is that it shows a base case and an upside of emissions reduction potential. So the darker colored bar graph shows essentially base case, and the lighter is upside if we can capture all of the emissions reduction potential. Something important to call out here is that Drawdown is a very courageous initiative to collate hundreds of scientific studies, as I said earlier, and it's a snapshot in time. So it's very important for us to recognize that science is evolving all of the time. We get new IPCC reports very frequently. I think the last one was just 2 weeks ago. And frankly, the trend in these reports is that each one that comes out paints a more dire picture, because the more we learn about the climate crisis, the more we realize how severe it is. So while Drawdown is a very courageous effort to collect all the scientific data, it's important to recognize that we need to keep it fresh, and we need to continue listening to science to help refine our strategies as we apply them. The second use case for Drawdown, for Align, is for us on the investments team to utilize it as data points that help us narrow in on the most high urgency and high potential solutions within a given sector. So here, for example, within the food, ag, and land use sector, Drawdown breaks it down by specific solutions: plant-rich diets, reduced food waste, forest protection. And we at Align will take these lists and highlight, okay, plant-rich diets and reduced food waste have an enormous potential to reduce emissions. So while sustainable intensification for smallholders is important, it's from an emissions reduction potential does not have as high potential. And we utilize this directly for our investment strategies. So this helped us define that plant-rich diets was a high priority for us, and that just translated to us approving 2 alternative protein VC funds onto our platform for investor allocation. Another example of this is buildings. I don't think most people who are not intimately familiar with climate might not think about buildings as the first thing when they think about climate investing. But as we saw in this slide, there's a substantial opportunity set with buildings. And so we utilize that evidence and data to justify to our clients, and frankly also to ourselves, the underwriting of a VC fund that exclusively invests in property technology, so making buildings more efficient and more sustainable. And the Drawdown evidence helped us get not only comfortable, but excited about that as a climate strategy. So that's, I realize it's probably better. That's the Drawdown framework. Mitigation, adaptation, resilience is a very classical climate framework. The shorthand here is mitigation is reducing emissions. This is the sole focus of Drawdown. Adaptation is learning to adapt and live with the effects of climate change, and resilience is increasing the capacity to absorb and bounce back from adverse effects. I think it's very important to recognize that Project Drawdown is an excellent tool for breaking down mitigation solutions, and it does not take into account adaptation and resilience. So it is fundamentally incomplete if we're looking at all climate solutions. Adaptation and resilience are chronically underfunded, both in private sector and in public sector, and so they really we cannot neglect them. So Drawdown is very helpful, and one should always sort of keep an eye and an ear out for adaptation and resilience investment opportunities. And the last framework I'll share is one that we use at Align to map maturity of technologies to the most appropriate asset class for them. So for those technologies that are innovative, let's say breakthrough technology for long duration battery storage, that is best addressed through a VC or PE strategy. Whereas distributing a proven solution like wind farms, the technology is pretty stable, incremental improvements, that is best addressed with real asset capital or perhaps private debt. And conservation, like protection of forests and grasslands, is frequently most easily accessible through real asset strategies. Again, this is a both and. We need to innovate and we need to scale and we need to conserve. So it's just a matter of finding what type of capital can each investor deploy and then mapping that to the maturity of technology, or reverse. If an investor feels very strongly about wanting to be at the front lines of innovation, then VC and PE would be best suited for them. Okay, now we'll take those three frameworks and apply real life investment opportunities, ones that we've underwritten here at Align, to understand where they fit in. So this here is a matrix where on the vertical axis, we have the 9 drawdown categories. The first 5 are sources, and then the latter half are sinks. And on the top, we have asset classes. Similar to what I just shared, if there's an investor who really can only deploy debt capital, one can use a matrix like this to understand, okay, which investment opportunities might be available. And I'll just share from the outset, this is absolutely not complete. There's many other opportunities. These are just the ones that we have approved in the last year or so. So if one wanted to use private debt, you could say, right, I'm excited about debt and I want to decarbonize hard industries. I can use venture debt for industrial sustainability innovations. Or I want to contribute on the sink side, and there you can lend to smallholder farmers in Africa and Asia to help them improve their practices in a sustainable fashion. Real assets and real estate, there's a lot of opportunity. VC, there's a lot of opportunity. Debt has actually been a little bit harder for us to fill in, but there are opportunities and increasingly more. I'd say the takeaway from this slide should be, again, there's a flavor for everybody. This is the same information displayed differently. So we have actual investment fund. Yeah, these are all funds. Funds, mostly private with 2 public at the bottom, mapped to a drawdown category, mapped to the segment, the aligned segment if it's innovating or scaling a solution. Geography, I will be the very first to share that we at Align have had a tilt towards North America and the US, and not out of, not intentionally, but reactive to situations. And that's actually something that I and my colleagues are working very hard on to rebalance the scale and deploy more capital in emerging markets, because the need is extraordinarily high, the additionality is high, and the opportunity is really high. So that's the geography, asset class, and I think perhaps the most interesting column to point out here is the target return. So if an investor is seeking a typical VC 22% net IRR, you can get it with climate investing. Or if you're looking for a capital preservation strategy, you can do private debt with a 2% return. There's everything along the spectrum, and this is actually not including philanthropic capital, which we also believe is an important lever to press. This is a mapping of investments by return on the vertical axis, liquidity on the horizontal, and essentially the Z axis is risk. in the coloring. And we'll populate this one by one by asset class. So first, these are all private debt opportunities. You'll see they have sort of medium liquidity, but quite a big range of return. The smallholder agriculture, that's the 2% that we saw on the last slide. And this venture debt for clean tech is a 14% return. So pretty high return there. VC and PE opportunities are unsurprisingly the least liquid and the highest return. There we have the property technology VC that I mentioned earlier, which is helping buildings become more efficient, both in terms of energy, but also water usage and waste. Alternative protein VC, so that's finding, developing both plant-based and cultivated proteins to lessen the use of animals in the supply chain. Beef is an extraordinary contributor to emissions. If beef were a country, it would be the third largest emitter after the US and China, and even more than the billion-plus population of India. So again, we feel very bullish on alternative protein and industry decarbonization. There's a lot of heavy industries that are going to have a really hard time switching over to renewables for various reasons. And so that is an initiative to help heavy industries begin that transition. All those are available at high return, or at least we hope high returns. We'll find out in 10 years when these funds wrap up. In terms of real assets, we have a quite wide range in terms of liquidity. This is a utility scale, clean energy on the far left, that returns 7% and is semi-liquid. And then we have funds that are 10-year, 12-year funds, some that are transitioning conventional farmland to organic and or regenerative, more clean energy, mitigation banking, which is really neat, that's falls within the conservation bucket. And here the range of returns is 7% to 12 or so. And now adding some public markets. These are of course the most liquid options, green bonds for principal preservation, and then a slightly higher return for equity fund. This is a different mapping utilizing the drawdown categories. So we have food and ag in the top corner, electricity, industry, buildings and transport, and land sink. And we're utilizing here our innovate, scale, and conserve align framework to build out this mapping. We have debt in electricity and food and ag. Unsurprisingly, this maps to the scale. VC and PE tend to map more to innovate, as shared earlier. And here are a couple of other opportunities that we have recently brought onto our platform. Real assets has a pretty wide range in terms of industry, and most of those, so some of them are scaling, so that would be the infrastructure, and then some of them are conserving. So that is, as you can see, sustainable forestry and mitigation banking to preserve particularly riparian waterways. And some public markets that are diversified, so kind of squarely there in the middle. Yeah, again, these are all within the subheading of mitigation. So if an investor is interested in mitigation and is interested in scaling, here are the options available. If an investor is interested in mitigation and innovating, those are the options available, and yeah, many more. And this is a similar slide, but for adaptation and resilience investments. I'll give a second to absorb. Wrapping up here, I work on our private fund side, so we'll present a little bit on public markets, but please go easy on me on the public markets questions. I can pull in a colleague. With public markets, we don't map it directly to drawdown. We haven't found that to be very useful, since most of them are quite diversified by industry, but one can definitely utilize public markets to do climate investing. Within fixed income, one could either focus on the issuer. So if there were an aligned issuer, let's say Patagonia, the company, if someone or believed in their sustainability strategy, one could buy their bond, or one could do focus on the use of proceeds. So that would be, let's say Apple issues a 1 billion bond to do sustainability initiatives on their campuses. That would be the, focusing on the use of proceeds. We'd align prefer the latter, use of proceeds. We see a more direct connection to sustainability and additionality with our investment dollars. And then with public equity, this is probably well known by many on this call. There's a couple of different approaches. These increase in impact as you go down the list. So first, one could divest from fossil fuel companies. Then one could have a more active ESG integration. There's a lot of really exciting work going on to refine which funds get an ESG stamp, because there's quite a bit of impact washing and greenwashing going on, with many claiming ESG and not following through with it. So that's something just to be aware of, to do the homework and make sure that a fund that isn't labels itself as ESG aligns with the values that you're seeking. And then a more proactive approach would be to get a low carbon index fund, and then even more thematic solutions. So that could be a fund that is exclusively investing in clean tech, let's say. That's it. I want to save some time for conversation. I will say that my personal life KPI is to move as much capital as quickly as possible to high impact opportunities. So if I can help anybody on this call, your organization, in accelerating that move, I'm very happy to. My email is here. Reach out, and I'd be happy to discuss.
Thank you, Yihana. That was really useful and interesting. I have a couple of questions, and then I'll turn it over to Moya for the panel. My first question draws off your last point. Do you, and I clearly, obviously you have a bias here because you oversee private fund investments, but do you think that the best way to achieve the goal of moving as much capital as possible is through the private markets as opposed to the public markets? Like, what is the most efficient action that particularly institutional allocators can take that will have the biggest impact?
Yeah, this is a sort of classical public versus private markets. Public, obviously much larger movement of capital is viable, and private, I think a much more intentional movement of capital is possible. What I would suggest is align the public markets as much as possible with ESG and climate forward strategies. And for those institutional investors that can, lean more heavily into private markets. There's so much to be done. It's much more targeted impact. And I think that there's actually more evidence for impact within private markets. Unfortunately, the engine number one success stories are few and far between. They're there, but they're few and far between. And I think it's easier to underscore the impact with private. But that said, I'm totally biased, and I'm sure my colleagues on our public markets team would say the opposite.
Yeah, no, I did kind of tee you up for that one. One of the things that I really like about what you guys do, and why I was excited to have you speak, is you prove that it's possible to have, Project Drawdown aligned portfolios that, have institutional type investment returns, either sort of in the 20s for private equity in particular, or sort of in the teens for infrastructure. And you alluded to this a little bit, but how do you feel like you have enough deal flow? Like, are there now enough good funds out there to really sort of build portfolios? And how does that differ from, say, 5 years ago?
Good question. Yes, there's definitely enough deal flow, and there are certain asset classes where we have an easier time finding the deal flow than others. Within VC, there is a plethora of strategies, just so many, in part because new technologies are coming on. And so in the maturity spectrum, those are very much in the innovate. So they need to start there in VC, and in part because there's a lower barrier to entry for VC fund managers. I think it's harder to be a real asset fund manager having not had real asset experience before. So there we see a lot of opportunity in PE as well. Those tend to be more consolidated around bigger names. In real assets, we see a lot of infrastructure. It's not always easy to get in with the smaller ticket sizes. Infrastructure funds tend to have smaller ticket sizes, and ours are small. Their minimums tend to be high and sometimes inaccessible, but we've still found plenty to keep us busy. The places where I'd say we have a harder time filling our buckets are within real assets under the conserve strategy. So it took us a really long time to find a real asset farmland strategy that we felt was high impact. We're very happy to have found one and brought it onto our platform, but that took a long time. And similarly, I've been working on tropical forestry real asset search for a long time and haven't found too many easy matches. John from MacArthur can speak to that a little bit later because he has some good experience there. And private debt is the other area where we're currently having a hard time finding opportunities, particularly high yield. Low yield debt is easy to find, high yield debt is harder. And to the last question of how does this look compared to 5 years ago, all asset classes have increased enormously in opportunity set, particularly VC, but the other ones as well.
Do you have an opinion on pure play for investment firms versus asset managers that do many things and are now adding an impact or ESG strategy?
We don't have an opinion in the sense that we would prefer or exclude large asset managers that are entering the impact space, but what we do is put them through a rigorous additional screen that we don't put other managers through. So we call it our conventional manager firm impact scorecard, where we want to see, okay, it's great that X firm has a long history and is coming over to sustainability now. Great that you have a clean tech strategy. But if that firm has a clean tech strategy and across the aisle, there's another strategy that is still investing in fossil fuels, that's not an alignment. And we would opt for a smaller manager that maybe has less resources, but is fully committed. Something that was important for us to clarify, and we, with our investment committee, when we discuss this, is to evaluate those conventional firms by forward-looking activity and not retroactively. So if they were investing in oil and gas before, but today commit to no longer investing in oil and gas or are moving fully towards sustainability, we're happy to work with them, and we won't penalize them for what was done retroactively. And that was important for us to clarify, and I don't think it's necessarily, there's no right or wrong answer there. One could say, like, we knew that oil and gas was not good for a while now, but that's what we've decided to do in order to encourage large firms to enter the impact space.
That makes total sense. All right, I think at this point would be a good juncture to bring in Moya Connelly, who is a good friend to High Water Women, and among other things, a professor at the University of Virginia. Moya.
Thank you, Imogen. It's great to be here today, and we have a great panel to talk to you about Project Drawdown and the work that they're doing in climate finance. I'd love to we had a great conversation prior to this, and I'd really like to leverage that and the discussion from Yihana about the aligned impacts work. So without further ado, let's just jump into the panel. What I'm going to do to begin is to introduce the panelists. To start with, I'm going to introduce John Balbach from the Innovative Finance team at MacArthur. Let him to give a little bit of introduction about himself and MacArthur.
Thanks, Moya, and terrific to be with all of you today. Thank you to Highwater Women for including MacArthur as part of this discussion. We're really proud to support their work, and it's a privilege to be part of this panel today. At MacArthur, we've been actively engaged in pursuing efforts to support climate change mitigation since 2014. This includes what we describe as a big bet initiative on climate change mitigation, where we've made more than 400 million in grants across a range of activities that seek to support the transition to a low carbon economy. We're also working to strengthen the alignment between our endowment investment portfolio and our mission values and programs by beginning to divest from fossil fuels and ramping up investments in companies and funds that seek to address climate change. And lastly, we're deploying impact investments, which is the program where I serve as a director to advance climate solutions. And the way that we're thinking about, or the way that we think about impact investing at MacArthur is that we manage an allocation of our endowment, and then we make catalytic capital investments to support initiatives like the Catalytic Capital Consortium to advance the field of impact investing, and also to support our specific programs like climate solutions. And I can talk more about catalytic capital, what we mean by that, and why that's important to broader climate ambition, and happy to do that. So basically, you can see we're trying to provide support for climate solutions across the full continuum of capital, from grants to catalytic capital to profit maximizing investments. And we're also trying to act with the urgency and the ambition that's required as we're now squarely in this defining decade for climate.
Mm-hmm. Thank you, John. The next person I'd like to introduce is Renée Vassilos. She is the Director of Agricultural Innovation at the Nature Conservancy, and which has the group itself has been doing a number of investments in the space.
Yes, hi, thank you very much, Moya and the Highwater Women team. Renée Vassilos, Director of Agriculture Innovation with the Nature Conservancy. We are, if you kind of looked at the Project Drawdown framework, we are very squarely in the agriculture space, and we are doing investments around protecting ecosystems and shifting how agriculture is actually produced. So more specifically, I manage a pool of venture capital that we refer to as our venture as a service. So I work in very close alignment with our North American agriculture team that has incredible, robust understanding of the challenges and roadblocks that exist to actually changing practices on the ground at scale. And based on the knowledge and information that we have, we look for companies that will mitigate, circumvent, or totally disrupt those existing challenges and roadblocks to scaling regenerative agriculture practices. And we look for companies that will scale one or a multitude of the critical practices we know do build soil health, and soil health being kind of the critical, if you had to focus on one specific thing in agriculture that will drive critical changes, it is in fact building up soil health. And so that's where our focus is. We have 7, soon to be hopefully in 2 weeks, 8 companies in our portfolio today. I think we're going to share a link in the notes so folks can take a look at what's in the portfolio today. But as we'll probably kind of get into, it's a range of investments because the challenges on the ground are pretty diverse. So there's fintech companies, there's autonomous tractor solutions, there is an alternative to the high-ravage nitrogen fertilizer method. So a wide range of solutions because the challenges are also wide-ranging. Thank you, Moya.
Yes, thank you. The next panelist that I'd like to introduce you to is Hannah Friedman. She's an associate at the at Closed Loop Partners, which is a company that, or an investment company that is investing in the circular economy.
Excellent. Moya and Highwater Women, thanks so much for having me today and for all the work that you do. And to my fellow panelists, it's a privilege to be up here speaking alongside you. I have so much to learn from you. As Moya stated, Closed Loop Partners is a New York City-based investment platform and innovation center, really two sides to the same coin, furthering the circular economy. And so I sit squarely within the venture capital group of our investment platform. And across that platform, we then grow up through the growth equity stages, through asset-backed lending and catalytic capital at the kind of infrastructure stages, and even through the private equity side in much more mature companies and a true buyout strategy there, really meeting companies at any stage of their development through that arc of capital. And our investments in circularity take the really holistic aperture across sectors and material types, inclusive of plastics and packaging, food and agriculture, fashion and beauty, and supply chain optimization and enabling technologies that really touch all of the material types of built environment and cement, inclusive of batteries and recycling of energy assets and electronics, and even thinking, as we see this burgeoning field crop up, about the use and capture of CO2 molecules that are really in the wrong place up in the atmosphere and need to be brought down, drawn down per se, and better utilized. And so that holistic view of keeping materials in play at their highest value for as long as possible is how we define circularity. The flip side of that coin is our innovation center. This center is helping bring together large corporations, many of whom are LPs with us, and solving for specific challenges or bottlenecks in the circular economy where pre-investment grade solutions actually need help to test, pilot, and iterate in order to reach that market readiness. So thinking about how do we as a Closed Loop Partners organization really bring the entire industry up to maturity for the circular economy.
Thanks, Hannah. I'd like to also introduce Amie Patel, who is a partner with Elevar Equity. It's a company that is investing in emerging market venture capital.
Thanks, Moya. It's great to be here and amongst such great thought leaders in this space. We at Elevar have been investing for over 15 years, but we bring a slightly different angle to this conversation. We focus on building distribution models that deliver essential products and services to low-income and underserved populations. And we have a portfolio that we've built out across India and Latin America, over 40 companies in both of these geographies. And I think what's important from our perspective in engaging in this conversation and thinking about the Drawdown project is, how do these billions of untouched or underserved individuals contribute to the overall climate discussion, and how can they be brought into the conversation and towards and into the solution? So when we look at thinking and furthering our interaction with our portfolio companies, there are two sides of the project and sort of this framework that we're speaking of today. One is on mitigation and the other one is on resilience. From a perspective of mitigation, we can talk a little bit later about how this may be more an isolated intervention that we may be able to unearth through particular investments where there is an environmental angle that's very explicit and direct. But most of our work is in the resilience, inclusivity sort of bucket, where we're really looking to meet the demands of these individuals who are just trying to survive and live life. They are takers of a lot of the solutions that many of you are building, and they participate in the infrastructure that is available to them. But yet we still need to educate them, provide food and access, and include them in a broader society. And so our role in that is building distribution models that creates that environment for them.
Right. Thank you, Amie. And I guess a little bit of introduction for myself. My name is Moya Connelly. I'm a professor at the University of Virginia, where I teach impact and ESG investing. I'm also an advisor who is setting up a climate finance fund of funds. And that Climate Finance Fund of Funds will focus on providing catalytic capital in order to move the market, the emerging market solutions, or the solutions for emerging markets better and faster. So we're always, Yihana had that great graph with where we were bending the curve, and we're just looking to bend the curve more and faster than what would exist normally. So that's a fund that should be launching this year, and happy to talk about that and the experience as we go. So Yihana is also going to join the panel, and she's already introduced herself, so I won't subject her to that again. Yeah, so without further ado, let's jump in and talk a little bit about the investment strategies that people have. We've talked to you a lot here about Project Drawdown and climate finance. It would be great to hear from the panel exactly how are you implementing your climate finance. So looking at this from the impact management and metrics, how are you, what are your goals and how are you implementing that? Okay.
I'm happy to maybe jump in, offer some fodder for also my fellow panelists to riff off of.
Yeah.
Part of our investment strategy across the sectors that we outlined is to look up and downstream through the entire value chain. And so to reorient ourselves, I'm talking about the private markets and the private equity that we're often investing in these companies, and private debt. So our investment strategy then looks for impact that is net positive impact. And so we do try our best to quantify both what we think the upside is across a myriad of metrics, happy to speak on that in a moment, but also being cognizant of potential negative externalities and really doing that equation to make sure that we are netting out in a positive way. When we think about the metrics that we measure at Closed Loop Partners, we report on metrics to the IRIS Plus metrics from GIN, G-I-I-N. Those include greenhouse gas emissions avoided and reduced, tonnage of waste diverted from landfill, freshwater gallons saved, as well as jobs created. And I know that wrangling metrics across multiple different asset classes can often be a challenge, but that's how we start to think about streamlining metrics both within the individual portfolio company up to the fund level and then across the asset management platform. And so I wonder how the panelists here also think about measuring for some of that net impact and rolling it out across their strategies.
Mm-hmm.
I could jump in. So as I had mentioned, we have a very tactical strategy that's tied directly with our boots on the grounds team that's trying to drive change on farm. And so in terms of our impact management, we tie what we're looking for towards what our agronomists and economists have determined are critical for building soil health. And so those are acres under cover crop, acres under minimal till, no till, increased rotation, and input optimization on farm. So we are looking for solutions that will scale one or a multitude of those practices. In addition, we're also going to be expanding. We're working on our phase 2 strategy where we'll be expanding the effort, and we'll also be working with our sustainable grazing lands team, where we'll be looking for solutions that are helping to facilitate the scaling of sustainable grazing lands management plans. It sounds pretty basic, but that's actually where you have to start if we're going to be scaling around grazing, which, as Yihana did a great job identifying, beef is just an incredible contributor, and so there's a lot of opportunity there. And so that's how we're looking for impact when we're assessing potential deal flow. And the other pieces that we're focusing on, because we're not writing the largest checks, and so it's not necessarily the size of the check that's the most impactful, but the other objective that we're trying to leverage by us actually sitting at the investor table is a signaling strategy for other investors, so those that have the larger checkbooks. And so to really signal to others in the food and ag space, or the growing group of folks who might consider themselves climate mitigation investors, around where we're investing and why. So really focusing on where and why behind our investments. And then also to signal a sense of urgency that we have, again, because we are intimately tied with our folks on our team that recognize we are not moving the needle fast enough by any measure. So so that's our kind of how we're actually looking to assess the impact, and also kind of our signaling strategy around impact as well.
Mm-hmm. You know, I think there's a theme here, you know, where there are several investors on the panel that are earlier stage. And I was wondering, you know, if you could talk a little bit about is there a friction between coming in very early stage, having this impact lens, and working with these companies to implement or to understand what they're and to work with them so that they incorporate impact into their strategies?
I can give a little bit of a sense from our lens. We don't really separate impact with building the business case at all. They should be inherently interwoven into one another, to the point that the KPIs that we identify for each of our investments actually are the part of the cadre of key critical KPIs that any early stage entrepreneur needs to focus on to get out of the gate. And each of those KPIs gives us a sense of the breadth and the depth of the market that we're reaching and targeting, as well as how sticky our solution is with meeting the needs of our customer segment. And again, so from the conversation and the lens that we're having from here, we're trying to uplift and improve the livelihoods of millions and millions of individuals and enterprises in order to then further their capabilities of tackling some of these broader, more environmentally focused challenges. So for us, the conversation is really around the affordability of delivering that product or service to the end customer. And I would imagine that that's probably a similar sort of framework in building out these businesses in other aspects. But it is forcing those conversations early, identifying those KPIs quickly, and then having them be focused on like a successful, sustainable enterprise, as opposed to managing through 20 different KPIs or lots of other components. Getting to the measurement component of like how we're actually contributing to a net zero or bending the curve or thinking about how we're impacting the overall universe, I think given that we're early stage investors across most of us, it's really creating that DNA and that ethos so that once you get to scale, it's already built in, no matter what kind of capital comes into the cap table and helps these companies get to an even larger enterprise. So the intention is to have all of that built in, the practices built in, and to think about what their measurement practice is going to be over time, not necessarily to being as demanding from the very first day. So it is an evolution, and one that's staged purposely based on their trajectory and growth milestones.
Mm-hmm. And I'm happy to follow that, and I'll start by just saying, Amie, I really appreciate the focus that you're taking around the social component and the just transition element of this. That's something we've tried to do. We've tried to center equity in our climate solutions big bet, and just really appreciate your leadership there. Happy to talk, Moya, about the early stage question, but maybe I'll frame it with our broader approach. And I mentioned that we're focused on catalytic capital, and the way we think about impact investments at MacArthur is we're managing a separate allocation of our endowment. We manage it like a quasi-revolving fund, and then we're deploying these catalytic capital investments to specifically advance the theories of change of our programmatic priorities, like climate solutions and initiatives. And the way we think about catalytic capital is it's capital that's willing to take disproportionate risk, or and or accept a concession in some kind in order to generate impact or to mobilize additional capital. And that kind of fits into our broader strategy, which is we're starting with the problem we're trying to solve. And when we look at a climate investment, we start with our theory of change, and we determine why we would want to do a financing strategy versus a funding strategy. And then we look at the capital gap, and we want to identify high impact capital gaps that if addressed could result in systemic impact and outcomes towards the theory of change that we've identified. And so it's problem first for us, and then we'll look at the investment tool to address that, whether it's equity, whether it's debt, whether it's a guarantee. But we don't want to be prescriptive in going in with that in mind. And we're fortunate with the type of institution that we are that we can take that approach. And an example of that is we have 3 buckets that we're focused on. One is high additionality, climate relevant innovation, and also innovation that intersects with diversity, equity, and inclusion. We're also looking at the acceleration of clean energy and energy efficiency in historically marginalized communities. And then the last one is we're interested in the acceleration of rooftop and off-grid solar in India. And on that innovation piece, we made an investment into a fund called the Prime Impact Fund, which we're extremely excited about. And it's because they've really intentionally constructed their fund to bridge a really pernicious capital gap, this technology commercialization gap, where they're coming in upstream from traditional or conventional venture capital, helping bridge high impact technologies, often capital intensive technologies that wouldn't be attractive until they're de-risked a bit, and helping bridge them to where a conventional climate focused venture capitalist would come in. And that's an example of one example of a capital gap, the innovation gap. And that's where we're trying to focus our capital and our investment priorities.
Mhm.
I can share from Alliance perspective, and actually we have quite a few parallels with MacArthur on that. Since we're not a fund ourselves, we look at VC funds and real asset funds and everything in between. Our impact strategy needs to be flexible to have the appropriate expectations. And to the point of early VC, we have different expectations on what impact reporting looks like than a mature real asset strategy, for example. So the way that we think about impact, or how we've structured our impact diligence, is first looking at theory of change, like MacArthur, where we really want to make sure that that there's evidence behind the challenge and the solution solving that challenge. I think often we see a challenge stated, but the link between the solution offered and whether that actually resolves the challenge is not always direct. So really looking to dig in there. We then evaluate impact execution, and that starts with the team members in the firm. Have they worked in impact before? It's great that they're investment professionals, but do they also understand the industry within which they're working and the nuances? So understanding essentially firm and team impact credentials. And then the second part of impact execution is seeing how impact is integrated along the investment strategy. So how is it integrated into due diligence? How is it integrated to deal structuring, into portfolio management, and into exit strategy? And then lastly, the third component is impact measurement itself. And again, it could be that some strategies are not measuring impact yet because their companies don't have financial data, much less impact data. So recognizing that we try to understand what the metrics will be. We definitely appreciate seeing alignment with GIN, IRIS, or some other standardized methodology. It just cuts out questions, makes it much more straightforward. And then throughout that 3-part process of theory of change, impact execution, impact monitoring, we're always looking for what are the impact risks. And I think the Impact Management Project does a really great job of laying out 9 impact risks, evidence risk, stakeholder risk, duration risk, etc. I would very strongly recommend anyone interested in impact management to take a look at those risks, because I think that helps surface challenges that might not be readily evident. I think in financial diligence, many are well familiar with what could go wrong, and with impact, it's a little bit less known. So that's something that we integrate across our impact analysis.
Awesome. I really resonate with what a lot of the speakers have brought up here, and I think it's so important to bring specific types of capital to fill specific types of gap and think about the most capitally efficient way to finance various amounts of the technologies that will apply to the different industries and sectors laid out in the Project Drawdown framework. And what Amie was saying earlier about, impact being part and parcel and absolutely integral to the very kind of origins of the company really resonates with me sitting on the ventures group specifically. So what's perhaps friction at that early stage might also be like the kind of joy of rolling up your sleeves and really digging in with these companies who are bringing a novel solution to bear and are very cognizant and awake to what their impact could be across their sector and supply chain. I think what I see as potential challenges in some of the calculations and the measurement here beyond just that impact management process, but as has kind of been stated here, there's kind of 3 challenges that I see having tried to build these impact models with a pre-revenue company. Sometimes the data of the company's operations simply doesn't yet exist, and that's the beauty of building at the earliest stage. A good example is for a novel reuse company who's helping bring reusable packaging solutions to market and eliminating those single-use items. Often you don't know what the return rate may actually be, and that impacts amortization of packaging costs, and it impacts the kind of life cycle analysis and GHG water and material footprint of those products. Sometimes, second category is that the translation of a business's operational data and their financial data isn't easily converted into impact. And so those conversion factors are either outdated or perhaps they're understudied. And so if you think about bringing novel materials to market and scaling those materials to replace, again, fossil fuel-based synthetic products and replace single-use products, often there's more science and research actually needed to accurately and in real time quantify the impacts of converting every dollar generated or every unit sold into what is the true impact of that new supply chain. And the third point is that I think this was brought up earlier, but the counterfactual is really hard to measure, and saying what the impact will be both up and downstream as the company scales is something that I think is being felt and heard across the industry, whether you're talking about carbon markets or whether you're talking about shifting some of these massive industrial point source emitters. That counterfactual is really hard to prove out and to quantify. And so I think efforts to help build those out and do that with as much academic integrity as possible is certainly where I think improvement can be had.
Thank you. Before we go on, I failed to mention that for the audience, please ask questions, put the questions in the chat, and we'll be happy to address those. Building a little bit on what Hannah just talked about, one of my questions is, this is a journey. So not only the companies that you're investing in, they're on their own journey, but as investors, we're also on our own journey. Can people talk a little bit about their investment strategy and their investment thesis and their impact theses, and how those have changed over time? How have you specifically related to climate finance, were there, did you go in one direction and then decide that there was another better solution that you could work with? If people could talk a little bit about that, that would be great.
I could jump in. Maybe you saw me smiling over here. That was definitely the case for my body of work. It started about 2.5 years ago, and the initial thinking was that we would be supporting soil health analysis. Well, the reality is we don't yet have, there's no, to date, we haven't yet found anything that is the perfect kind of soil health tell or metric. And so we had to really think differently about our investment thesis and what we were actually going to be investing in. And that's where we landed on this kind of very tactical strategy to tie to what the agronomic data and the economic data had told us around the practices that needed to scale to deliver on the ground impact. But it was a painful 6 months to think about how will we actually, where are we actually going to be deploying capital to have the impact that we seek? And so that was a challenging 6 months. And then I would just also say to your last question, Moya, the other challenge that we've seen is exactly what you indicated. We are investing in very early stage companies, so majority Series A companies. And what we recognized was that just having access to the venture capital, the investment equity capital, wasn't sufficient to get after the impact that we're looking for on the ground. And so for the phase 2 of our work, we're looking to raise not only additional funds for investment, but a complementary pool of philanthropic capital to support innovation grants. So to actually work with the companies to design and test the impact-oriented solutions in which we've invested. So it kind of gets to Hannah's point around, well, not even actually, well, and Yihana, you mentioned it too, not just the measuring of the impact, but before that, the testing, right? Like, what did we actually invest in, and can we get to a place to actually test impact? So just wanted to highlight that was also kind of a challenge that we recognized kind of after this initial 2-year pilot, that simply having the equity capital wasn't enough to deliver kind of the on the ground impacts that we seek.
Mm-hmm.
I'll just echo that one point. It's one of the elephants in the room when it comes to outcomes and sort of what is the actual impact is who funds that research and who gathers those details and who verifies them and who's going to pay for that. And LPs are constantly squeezing GPs on fees. And so this becomes an extra component for anyone that has a dedicated impact strategy. That's an extra cost. And so for us, I mean, I could speak about Elevar, we have not gone down the path of figuring out the outcome of our work because of that element. But I do think there is room for measuring the impact, seeing where there's room to improve, there's engaging with other partners in the space, leveraging other people's practices, and then getting to a better sort of insights there. From the perspective of how we've evolved as a firm in our journey with intersectional and climate, I'd say, 5 years ago, it wasn't even on our minds at all. And over the last few years, with COVID, with the extreme weather, just all the other components that our customer segment continues to face firsthand, we now are pushing our own thinking and our entrepreneurs' thinking about how to engage in this conversation. I don't think we know fully, and I think that's going to be a journey for us. And then the companies that we're building with our entrepreneurs, what kinds of questions should they be asking and when, with regards to their overall footprint, with regards to how they can adjust their business model to be leading in an industry. So for example, we have a two-wheeler financing company that gives access to mobility to individuals who prior did not have access to purchasing a bike or any sort of transportation. And we're focusing mostly on rural populations, which have even less access. And the majority of the borrowers are actually right now women. So it's a mobility and freedom play, but they're still run on diesel, right? Or gas. So how does a company like this work with OEMs to create a bike that is affordable at a price point for this customer segment and leapfrog into an EV model? Then you think about, where does the battery fall in? How do they charge? Do they have that kind of flexibility? That customer ground up insight is critical in building a solution that's long-term, that sort of can weather a lot of the changes in the industry. But that's something that's new. We would never have thought of that a few years ago. It's much more front of mind. We're having much more active conversations and thinking about what we can do. We have another company in Latin America that's in the supply chain of delivering food at affordable prices. But there's packaging, there's logistics, all of those things. Again, something that we would never have been exposed to, but now that we're here, we're asking the questions, what are you thinking? What's your plan? How do you build that into your unit economics so that you maintain affordability for this customer segment, but also don't have an outsized negative implication on the environmental side of what your footprint. And that's an ongoing conversation. And I think there's a lot of room for us to partner with others to bring best practices to the forefront.
And I can jump in with a couple of thoughts on our end. So one is I mentioned we're interested in accelerating rooftop and off-grid solar in India, and we engaged a few years ago with a collaboration of foundations, the government of India, the USDFC on this topic. Our sort of going in hypothesis was that we would create a larger blended structure that would take on this issue. But we tried to take a data-driven approach. We did a landscape assessment, and as we really got into the details and the numbers, it became clear that we needed to break that up and do a series of interventions. And the numbers indicated, or the data demonstrated, that capital was flowing pretty effectively at utility scale and at large scale commercial, but as you start to go down market, it gets blocked. And there were a number of potential ways to take on that challenge: credit enhancement, supporting a purpose-built specialty finance organization. And one of the investments that we made, Encourage Solar Finance, was an investment into a fund that was making minority equity commitments into non-banking financial companies in India, or NBFCs. And what was exciting about that is it was investments within the Indian financial infrastructure. And the idea was that it could create a demonstration effect that the economics work for these transactions for rooftop solar, and it would help move larger investors down market into this space. And that's incredibly relevant because that segment represents about a quarter of India's power consumption. But the point is, we went in with sort of a hypothesis, but we allowed the data to move us in a different direction. And that different direction was a type of catalytic capital that we've grown to understand is extremely important within the climate space. And that's this idea of not necessarily a blended structure, or what we think of as vertical catalytic capital, or catalytic capital that's coincident with the capital it's trying to leverage, but horizontal catalytic capital, meaning you're investing, like the prime example I mentioned earlier, you're investing earlier than conventional investors, possibly demonstrating, helping to build a demonstrable track record for early managers, demonstrating the viability of new products, demonstrating the viability of critical sectors like what Encourage Solar was trying to do in India. And that, just the importance of that, and specifically the importance of that for climate solutions, has become extremely readily apparent to us over the last several years. And then maybe the last thing I'll say, going back to the impact question, because we're investing across a lot of different areas, we tend to shy away from aggregation of metrics. Instead, we look at the impact we're generating. We look at it as sort of a heat map, and then we allow so we can assess progress, but we look at it at an individual investment level. And then you can drill down to assess the impact at that level. And we find, if we were to try to aggregate the metrics, it would become something that is diluted so much that it becomes almost meaningless. And so we really want to try to track it at that level, progress, but then be thoughtful and specific to the investment when you do the drill down. And that's been another learning for us as well.
Mm-hmm. Mm-hmm.
John, I think that's just an incredibly powerful example of the power of enabling impact and really defining some of your goals for that enablement. And one of the things, like, I agree that the aggregation of metrics can be challenging and present its own flattening. And so too, especially in the venture space, we're seeing that flattening happen with the greenhouse gas metric of CO2 equivalent. And I think trying to push all of these dimensions of impact toward that one metric, it has its benefits if you can defend that you are narrowly focusing on mitigation impact, which there's so much work to do in that space. There's so many investable strategies within that. But I think, and I think that Closed Loop has also taken a stance that we too are excited about investing behind enabling impact, whether that's across the adaptation or resiliency kind of parameters that were laid out in the fireside chat. I think you need all of these pieces of the puzzle to kind of work together. To Amie's example about the bikes, right? You need distribution channels and consumer-facing sales channels in order to then help scale the innovations that are coming in electrification and otherwise. And so I really do think that as we've watched, especially in the venture capital sphere, certain funds set a goal of gigaton hurdle by a certain date or multi-gigaton hurdles for their particular investments, that is perfectly apt and needed for particular strategies. And I think there's additionality in strategies also. A couple of the leaders of Closed Loop Partners often pose this back to me. We've got Tasia Smith, our Chief Operating Officer, and Danielle Joseph, our leader of the venture fund. They're often like, Hannah, how are we building to a future in which we're also going to not just survive, but really thrive? And that encompasses metrics across biodiversity and water and jobs created along the way.
Mm-hmm. Mm-hmm. So, you were, Hannah, just to build on what you just said, you were talking about the investments that you make, and I thought it would be really helpful for the audience to hear about any a particular investment that you and the other panelists have done that shows both the impact and also the investability of these types of solutions.
Sure. I'll maybe chew on my own framework there and speak to investments across reduction or the kind of sources, sinks, adaptation, and resiliency. So in the reduction side of things, actually alongside Drawdown Fund, we've invested in a company called Mori, which is a silk-based edible and odorless protein that extends the shelf life of fresh produce, can even go on things like meat and your cough drops, which actually need a lot of kind of oxygen barriers and packaging in order to stay good. And so that extension of shelf life reduces food loss significantly at points of consumption and retail. And it's a great example of, by reducing lost food, you're eliminating the emissions of that food prematurely going to landfill and decomposing into methane. You're also potentially creating upstream efficiencies where food can be, they can go through supply chains a little bit longer and a little bit more efficiently. So some transport emissions reductions associated with that. On the sinks side of things, or the true drawdown, we have invested in a regenerative agriculture enabling technology called UCropIt. This is a Buenos Aires-based company who is helping farmers get paid actually to document the work that they're doing in cover cropping and no-till practices, which we found has been a critical pain point to ask the lowest margin players of the value chain, the farmers, to then pay for the metrics and sensors and data platforms to help them improve their ag practices. I'm sure Renee is going to have a lot to say on that point. And on the adaptation side of things, we've invested in a company called ThriveLot. ThriveLot helps you rewild your backyard. And so if you can think about the suburban US customer, folks who spent so much time at home in the pandemic and on their back patios thinking, I really am so tired of pouring chemicals to keep this lawn green, and I'm now facing state challenges limiting my irrigation of this lawn. How do I start to think about bringing in native species, bringing in pollinator habitats and wildlife habitats to potentially even grow food in my very backyard? And so ThriveLot is essentially the project management platform and marketplace to connect a trained agroecologist to that homeowner who understands the benefits of transitioning their backyard from something that's pretty linear and chemically toxic into something more biodiverse. Last but not least, resiliency has been a huge theme for our supply chain and manufacturing investments. And so we've invested in a Brooklyn-based company called Parsimony, and Parsimony matches manufacturing capabilities. So a CNC or particular plastic injection molding manufacturing shop, and brings them onto the platform to then connect with hardware producers. Let's say if you were building one of Amie's bikes in her portfolio. And so by creating digitization of that supplier producer relationship, you're actually able to present solutions in which you would say, oh, actually you can design this part out of recycled content, or oh, actually the manufacturing capability that you need is not a Google search away and 2 continents away, but instead it's like actually next to your backyard and can ramp up in your nearby city with you from prototype up through production. So those are some good examples of how with both measurement of direct impact for things like Mori and You Crop It, but also through enabling impact like ThriveLot and Parsimony, we've kind of outlined our strategy.
Great.
I could jump in and actually kind of piggybacking on ThriveLot, Hannah, that you mentioned. So one of the companies that we invested in is called Kula Bio, that is looking to disrupt the synthetic nitrogen fertilizer production process, the Haber-Bosch process. It's a biological alternative, and they are producing, so 2 interesting things. Not only is it tremendously impactful to kind of disrupt that traditional method that has actually delivered tremendous gains for all of us as humans, but now we recognize it's time to think differently about how we're actually fertilizing our ag production. And so that's what they're working on, is a disruptor, but also they're working to get the cost so low that they would actually be able to set up bioreactors on farm. And so the idea that you would be disrupting the distribution channel, which is a huge roadblock to actually driving on-farm change. So the logistics around when fertilizer is delivered at scale and the price that it can be purchased at is one of the challenges that we have to disrupting the status quo use of the traditional nitrogen fertilizer. And so Kula Bio is not only disrupting how it's produced, but also the distribution, which has potential tremendous impacts. But in terms of the investability of this, there's several tailwinds that make the idea of disrupting this hundreds of billions of dollars of industry incredibly compelling. First of all, we're starting to see input constraints. So to actually continue delivering synthetic nitrogen fertilizer, there's pressures on that system. Then there's also regulatory pressures. So Hannah mentioned actually at the city level, maybe some folks around their lawns are facing regulatory pressures, but so are, it depends where you are. Australia is one of the most progressive. The European Union is also becoming more progressive, but there's a growing body of regulatory pressures on the industry. And then efficacy. So we're starting to see challenges around how we have been using traditional nitrogen fertilizer not delivering the same results. Host of reasons for it, but efficacy, so tailwinds around the efficacy of traditional. And again, this is hundreds of billions of dollars of industry. And so this is an incredible opportunity that both is tremendously exciting from an investment perspective, but also from an impact perspective.
Right. Thanks to everyone. I'm just noticing the time, and we're almost up on the hour. So I'm going to have I'll pause here and thank the panelists. I know that Alyssa and Imogen wanted to sort of speak to a couple of things that are coming up.
I just wanted to say this is Corey from Project Drawdown. I just wanted to say thank you, everyone. This was a great swath of all the drawdown solutions, the sources, the sinks, and society. You know, I'm really glad that we're starting to get into helping investors and capital allocators from the drawdown perspective. Just to give everyone a heads up, we're really doing research on the different timescales, looking into those quick wins, thinking like what's coming up now is thinking of the low-hanging fruit and the big value propositions like energy efficiency, stopping deforestation, the methane leaks that we talked about. I'm sorry, the methane leaks, and then the other things that we talked about today. And then we're also looking at the different timescales. So Drawdown's looking at kind of the infrastructure dependent, technology dependent, and nature dependent, and then helping allocators look into what actually works for them. So thank you so much, Alyssa, for putting this together, and Imogen.
Thank you, Corey, and thank Imogen for working on this two-part series that we've presented both in January and now. We've been talking about this for a good long while, and it's great to see it finally come to fruition and hopefully have additional sessions following this one. Imogen, did you want to pop in and say anything before I close it out?
Yeah, just very quickly, as most of you likely know, we've been working on this landscape of investable project drawdown solutions. We had actually a great response from our call for nominations, many of which were in this discussion. And we will be publishing that sometime in the second half of this year. So definitely look out for that.
Thank you, Imogen. And once again, on behalf of High Water Women and the audience, thank you to the panelists for taking the time to be with us today, for your expertise on this discussion. Thank you to all of the volunteers who make this work possible. Imogen, Corey, Amie, who's also on our impact committee, Moya for moderating. As you know, High Water Women is a volunteer-driven organization. So it's people who are dedicated to this work, who are passionate about impact, understanding impact, and helping others to implement impact strategies in their work. So it wouldn't be possible without your thought leadership and hard work. And thank you to our supporters, among whom our MacArthur Foundation, for your support in helping to make this work possible. If you're interested in becoming a partner in our work on the content side or supporting our efforts, please do feel free to reach out to me post this session. We are a small nonprofit and live off the kindness of others. So we would love to have you engage with us in thought leadership, in talking about impact, or any of our other programs. So and don't forget to be on the lookout for our next two sessions on the future of women in asset management, both on the women founder side, women who have founded asset management firms, tell their story and help you, and also a session hearing from women entrepreneurs, how they have built their businesses and how they have navigated the getting investors in their work. So we look forward to that. Again, thank you, panelists. Thank you, Moya, Imogen, Corey, Anna Murius, who is behind the scenes also helping out. Have a great day and hope to see you all very soon. Thank you. Bye-bye.